Investing doesn't have to be complicated. In fact, one of the most successful approaches is remarkably simple. John C. Bogle, the founder of Vanguard, laid out this path in his book, The Little Book of Common Sense Investing. His core message is powerful and liberating for new investors. It challenges conventional wisdom and points towards a straightforward, effective strategy. This strategy is built on logic, evidence, and a deep understanding of how markets truly work over the long term. Bogle believed that the average investor can achieve excellent returns by following a few basic principles. These principles cut through the noise and complexity often associated with Wall Street. They focus on what you can control. The stock market is a powerful engine for wealth creation over time. Historically, it has delivered substantial returns to investors. This growth reflects the innovation and productivity of companies around the world. As an investor, you don't need to predict which specific companies will succeed. By owning a piece of the entire market, you participate in the success of the economy as a whole. This is the fundamental insight behind Bogle's approach. Trying to pick individual winners or time the market is incredibly difficult. Most professional money managers fail to consistently beat the market average after costs. This is a crucial point that Bogle emphasizes. Remember, if you like the sound of this book and want a free copy, use the link in the description to get it for free with Audible. Costs are the enemy of investment returns. Fees, expenses, and taxes might seem small individually, but they compound over time, significantly eroding your wealth. This is perhaps Bogle's most critical lesson. Actively managed funds often charge higher fees because they employ teams of analysts trying to outperform the market. These costs are deducted from your returns, whether the fund performs well or poorly. Over decades, this difference is staggering. Even small differences in annual fees can lead to hundreds of thousands of dollars lost over a lifetime of investing. Understanding and minimizing costs is paramount to successful investing. It's one of the few variables you can directly control. Given the difficulty of beating the market and the drag of high costs, Bogle championed index funds. An index fund simply aims to replicate the performance of a specific market index, like the S&P 500. It holds the same stocks in roughly the same proportions. Because index funds don't require expensive research teams or frequent trading, they have very low operating costs. These low costs translate directly into higher net returns for the investor compared to higher-cost alternatives. By owning a total stock market index fund, you essentially own a slice of every publicly traded company. You get instant diversification across industries and company sizes. This diversification reduces risk compared to holding just a few stocks. Investing is a marathon, not a sprint. Bogle stressed the importance of patience and maintaining a long-term perspective. Market fluctuations are normal and should not cause panic. Trying to time your entry and exit from the market is a losing game. You risk missing the market's best days, which often occur unexpectedly. Staying invested through ups and downs is key. Compounding is your greatest ally. Reinvesting dividends and allowing your earnings to generate further earnings is how wealth truly grows over decades. The longer your money is invested, the more powerful compounding becomes. So how do you put Bogle's common sense into practice? It starts with saving consistently. Decide how much you can afford to invest regularly, even if it's a small amount to begin with. Next, choose a low-cost, broad market index fund. A total US stock market index fund or a total world stock market index fund are excellent starting points. Look for funds with expense ratios well under 0.10%. Invest your savings into this fund regularly, ideally automatically. This practice is known as dollar-cost averaging, which helps smooth out market volatility. You buy more shares when prices are low and fewer when prices are high. Finally, stay the course. Resist the urge to tinker with your portfolio based on market news or predictions. Rebalance occasionally to maintain your desired asset allocation, but otherwise, let the market work for you. John Bogle's Little Book offers a clear, evidence-based roadmap for investors. It empowers you by focusing on what matters, keeping costs low, staying diversified, and investing for the long term in low-cost index funds. This simple strategy has proven effective for millions of investors. It removes the stress of trying to outperform the market and replaces it with a calm, disciplined approach. You don't need to be an expert to succeed. By embracing common sense investing, you put yourself on a strong path towards achieving your financial goals, whether that's buying a home, funding education, or securing a comfortable retirement. Start simple, stay disciplined, and trust the power of the market. Remember, if you like the sound of this book and want a free copy, use the link in the description to get it for free with Audible. Subscribe for more summaries.